And welcome back to our third section on technical analysis. In this lesson, we'll be discussing probably one of the most important aspects to technical analysis, and that is, of course, identifying key levels of support and resistance. All right, some of the things we'll be covering in this session include understanding support price levels, understanding resistance price levels, using trend lines to identify points of support and resistance, and how to fan trend lines and what does that mean. So first up, support and resistance levels. Support is a price level where buying pressure overcomes the selling pressure and the price rallies. More than one point is preferable. So if we're talking about trend lines, we look for at least 2 points to start a trend line angle, third touch to confirm the trend line, and the more touches you get, generally the more significant, the more meaningful the level of support or resistance would be. The more times the price rallies from this support level, the stronger the level becomes. And of course, the more meaningful it is if it's ever broken through that level. And the same with resistance. So resistance is a price level where selling pressure overcomes buying pressure. The price typically falls. Again, more than 1 point is preferable. The more times the price fails at a key level of resistance, the stronger the level becomes, the more meaningful it is when it tests that level. So why are these levels so important? They are a gauge of what the market thinks is fair value, and this is a crucial point. It gives us a way of gauging whether a stock is at fair value, long-term growth potential. So if it's testing a key trend line, and is showing evidence of support at that level, it actually has a high chance of rallying from that level. So that allows us to buy into that pullback at a good value level with hopefully long-term growth potential associated with it. They can often determine the trading range of the stock. And of course, it can be important when timing your entry, exit, hedging signals, etc. Their importance lies in the tendency for them to remain in the memory of market participants. So the next time prices approach the same significant level of support or resistance, fresh buying or selling may emerge, and the price may actually pause or change trend at that level. So interpretation of all this, when markets approach a point of support and resistance, they will often pause and change trend. This provides you with a timely opportunity to take advantage of the next movement. So it could be to buy at support, it could be to simply sell and exit a position if it breaks through a key level of support. So here's an example of support. So this would be a horizontal line connecting two troughs. Troughs are sometimes referred to as V lows. So imagine an upside down or a V generally. And you need at least 2 points to have a support line. Ideally, a third touch would confirm it, but the minimum would be 2. So essentially, a support level is a level where buying pressure is likely to take place and a rally is likely to emerge. So buying near support gives us fair value or good value levels to be buying in at, and hopefully a good opportunity for further upward movement from these levels. Now, the opposite to this is resistance. So in this case, we've got a horizontal line of resistance connecting 3 separate peaks. So once again, we need at least 2 peaks to start a line and a third touch to confirm. So each time it tests this level of resistance, it's finding resistance there, selling pressure comes in, and a downturn takes place. So that could be used to take profits on an opportunity, or an advanced trader might be looking at short selling and trying to profit from the downturn from that level. So in terms of drawing trend lines, a rising trend line, we connect higher troughs. So again, a trough is essentially a V low that takes place in a stock or market we're looking at. We want at least 2 points to start our trend line angle. and a third touch to fully confirm it. Whereas a downtrend line is connecting peaks. So imagine an upside down V. So they're the peaks we're connecting. So the same rule of thumb, we look for 2 points to start the trendline angle and ideally a third touch to confirm it. So when it finally breaks up through the downtrend line, it suggests the end of the downtrend and the start of a new uptrend getting underway. There's another downtrend line here. 2 points starts the trend line angle, third touch confirms it. When the market breaks up through the trend line, we've got a good signal to buy, and of course the start of a new uptrend getting underway. And rising trend lines, as we've said, are the opposite. They connect higher troughs. As long as the price action stays above the rising trend line, the trend is still up, likely to continue. But should the market break down through one of these rising trend lines, we'd have basically a trend reversal being suggested and a likely downturn from that level. So here we've got some examples of support lines that later become resistance. And that's another interesting aspect to support and resistance lines. So if we look at this overall rising trend line, the green line to start with, it's basically a 3-touch trend line. And over here, we see the market eventually start to break down through the green trend line. And if you look closely, it actually has a little counter rally, tests the green trend line, begins to fail from that level. So what was once support can actually later become resistance. So always be wary if a market starts to break down through a rising trend line. If it rallies up underneath it and is unable to get back up through it, it has actually a very high chance of failing at that level, and further downward movement would be suggested. Over here we have a red horizontal line which was acting as support through points 1 and 2. And then later over here at point 3, we can see it actually breaks down through the red horizontal line of support. It actually rallies up underneath the horizontal line at point number 3 and finds resistance at that level, where it then fails and continues on down from that level. This is another example of support and resistance changing its roles. So we could say points 1 and 2 were acting as support, and then if we have a look over here at point number 3, it had broken down through the rising trend line, suggesting weakness at that time. We then get this counter rally, which some people would then be starting to assume it might be beginning to recover again. But once again, if it's unable to get back up above that trend line, it actually has a high chance of finding resistance there and failing. And sure enough, that's exactly what it went on to do. So in terms of drawing trend lines, we generally start trend lines from the extreme high or lowest point. So if it's a rising trend line, we start the trend line from the lowest point of the trough low that we are trying to connect. You can also start them from a lower peak or a higher trough. So occasionally, wherever possible, we would draw a trend line from the lowest trough low, the very beginning of the uptrend. Sometimes you'll find that starting a trend line from a higher trough will give you a better fit, and you'll actually get a better fitting trend line connecting more troughs. So at the end of the day, it's best to explore both options and use the method that basically fits the trend the best. So usually you'd start from the extreme low, connecting up to your higher troughs from there, but be prepared to experiment with drawing trend lines from higher troughs, and you'll find occasionally it'll actually fit that trend a lot better. So it's a matter of finding the method that fits the trend the best at the end of the day. So support lines are drawn connecting trough lows. They connect support points, suggest buying levels, they suggest a continuation of trend as long as the price action can hold above our rising support line. Resistance lines are drawn connecting peaks. and they connect together to form a resistance line. So each time the market tests that level of resistance, there's a high chance of failing at that level. But should it break up through that level, obviously it starts to suggest the beginning of a new uptrend getting underway. So both trend lines provide information on strength or weakness. So if they hold support, the trend is likely to continue. If it breaks down through a rising trend line, it suggests weakness. These provide opportunities to enter when the market bounces off a trend line. So buy at support. That's probably the most common setup most people would look for with a financial market, is to buy a pullback testing or holding a support line, such as a rising trend line, and try and profit from the rally that's likely to follow. Of course, we still need to look for a confirmation of a resumption of the trend or a change in trend at the time of entry. So always look for a signal to suggest the resumption of your uptrend or even a complete change in direction before entering or exiting a trade. Fanning trend lines is an interesting thing you'll find yourself doing with stocks. So here we have an example of a very shallow trend line that has been drawn, and we notice then the trend begins to pick up. It's nowhere near the initial trend line. So this then requires you to redraw the trend line connecting new higher trough lows, which holds the trend for a while, but then you can see the trend once again is accelerating, getting faster and stronger. It's no longer near our second trend line. So we draw a third trend line. Again, notice the third trend line is even steeper than the second, and so on. And so each time we redraw a trend line, you'll notice the angle of the trend line gets steeper. And what that's telling you is the trend is accelerating, getting faster and stronger in that direction. So as a rule of thumb, be wary of the third trend line in a fan. Very rarely do markets make it to a fourth trend line in a fan. So they generally can only do so much before there's a significant correction and profit taking that takes place. But the meaning behind a fanned trend line is the trend is actually accelerating, getting faster and stronger in that direction. Another interesting thing we can do trend lines is parallel lines. So we draw an initial trend line, and then we would draw a parallel line to the initial trend line. And you place the parallel line on the peaks in between the troughs that you've drawn the rising trend line on. And this creates an ascending channel. And the benefit of this approach is if we bought at support near the rising trend line, and then it rallies up towards the top boundary of the ascending channel line, the top boundary of the ascending channel line can be used as a point of reference for profit potential. So it actually has a high chance of finding resistance at the top boundary of the ascending channel line. So a little checklist for you on support and resistance levels. Always trade with the underlying trend. Obviously, if you're using trend lines, it's going to help you to see the trend quite clearly. Identify levels of support and resistance on your charts. Just remember, markets tend to have memories and often will change direction at points of previous failure or strength. And these are opportunities for you to take action in terms of finding a trading opportunity or entering in the direction of the underlying trend. Always wait for the market to confirm directional change before entering. So wait for a break of a down trend line. So that's your short down trend against the underlying uptrend. And this helps to confirm a resumption of the overall longer term uptrend getting underway. So we try and look for confirmation. The pullback is ending, it's finding support, and a new uptrend is starting from that level. And that's where we'd look to enter when buying a pullback on an uptrending stock. So some homework exercises for you to do. Scroll through your charts, draw some trend lines in different time frames, so daily, weekly charts, and determine key levels of support and resistance on your charts. Just remember that long-term trend lines are generally drawn horizontally, but they can also be long-term rising trend lines as well. So look to do both horizontal lines in conjunction with your rising trend lines, and you'll be surprised how many levels of support and resistance you actually do spot with those two types of lines. So thank you very much for joining us. I hope you've enjoyed that lesson on support and resistance today.